Welcome, everybody, to another episode of the Good Deeds Note Investing Podcast. I am your co-host, Jamie Bateman, flying solo as a host today. Chris was able to, we recorded 2 episodes today, so Chris took the first one, and this is the second one. Luckily for you all out there, it's not just me today. I am joined by Mark Willis of Lake Growth Financial Services. And Mark is a wealth of knowledge about all things financial and infinite banking and all kinds of things that we're going to get into. Mark, how are you doing today?
Doing well, Jamie. Thanks for having me on.
Absolutely. Now, Mark, where are you? Are you in the Chicago area?
Yeah, that's right. Yeah, we've had the privilege of living in Chicagoland for the last almost 12 years now, and seen some different phases of life. And when we first moved to Chicago, the skyscrapers were going up, scaffolding everywhere, and then boom, 2008, and everything came down.
Yeah.
And then it's come back up again.
Yeah, this is true. That was an interesting time for sure. So if you would, for our listeners who are unfamiliar with you, why don't you give us a snapshot of what you're doing right now, what your business looks like right now, and then we'll back up into more of your background.
Sure. Well, we work with clients all over the country, and we are part of the Bank on Yourself Professionals Program, which is a 200 plus member professional organization. It's the only credentialed program in the specific niche that you and I might discuss some today. And it's, both across the United States and Canada, but really we have clients all over the world, although our focus is in the United States. And we work with folks one-on-one in an advisory way to sit down and review their overall financial goals and objectives. As a certified financial planner, that's part of my duty, but it's also my privilege. It's so cool to get to meet with people, understand their at the end of the day, it's about the deepest stuff you can talk about. I don't think money is all that, it's not important intrinsically, Jamie, but I found that money seems to get into all the important areas of life: marriage, children, legacy, purpose. And when you allow yourself to let money only be the conduit to that great conversation, man, your job, my job in this case, is just tremendously valuable and rewarding. And I get to see transformation almost every day. So, what better thing can we spend our time doing all day long?
Absolutely. No, I love it. I love all these. I get excited about these kinds of topics. It's really, obviously Chris and I and most of our listeners are pretty heavily focused on mortgage note investing, which is fantastic in and of itself, but there's so much more to, personal finance and investing and wealth building. And like you said, I view money as very powerful, but not the end goal in and of itself. And so, like you said, it works its way into all facets of life. And I think it's a really critical topic that we talk about and, educate each other on. And I just love it. So, we were talking before we hit record a little bit about how we're both in the kind of bank on yourself or infinite banking space. So I'm going to have to force Chris to listen to this one because I've been in his ear a little bit about this topic. But like we said, we had Russ and Joey from Wealth Without Wall Street on previously, and they're kind of in the same little inner circle, I guess, in the infinite banking world. But so yeah, how did you get to where you are today?
Well, yeah, and you're right. You're among pretty rarefied air to be talking about that specific strategy with 2 different people. That's pretty 2 different groups. That's pretty awesome. And I'll just share, it certainly wasn't introduced to me as a kid or growing up or even as a young adult. The student loans were piling high when I graduated. We were up to 6 figures, 120 grand. When we graduated. With today's inflation, that would be close to about $250,000. And we graduated in 2008, which was a wonderful time to be looking for work, Jamie. And I had no real marketable degrees between my wife and I. So we were really starting off life just fine. So
if
that was
you're
sort
looking
of
for lessons, right? And
that's
how
right,
to get a job and how to overcome adversity. Yeah. Starting off.
And we had no plan, no budget. I mean, I remember our first couple of budget conversations, we were so like, it was so difficult for us to talk about money that we had to go to a public place so that there would be witnesses, just in case there needed to be some sort of witness to the
Right.
crimes committed. So we had
what were your degrees in? I'm just curious.
I got a master's in divinity,
Okay.
and my
Yeah.
wife got an art degree.
Okay.
So again, great to be looking for work in the Great Recession with 2 degrees that may or may not be
Super
not exactly
marketable.
engineer degrees or medical
Yeah.
doctors or anything like that, for sure.
Understood. Yeah. The truth is, my degree was in sports management, and I did take some business management. Half of it was business management, which I think is somewhat applicable. But
Right.
yeah, I can relate to getting out of school and saying, okay, now what?
Right. Yeah. Well, my wife jokes and says that as a master's of divinity, you can make really great chocolate. And I like to say that my favorite book of the Bible is the book of Numbers, because
Nice.
I really got focused on money, mainly because it was never taught.
Yep.
I mean, it's really strange. And maybe a lot of folks can listen, even if they didn't get a master's of divinity, you know, a lot of these management degrees, leadership degrees type deals.
Yep.
I was never really taught how to balance my own checkbook, much less help a nonprofit or a church manage a large budget. And yet we're, given this whatever leadership degree, and then the idea would be to go out and to lead a church or a nonprofit or something. That's the kind of the end result of a master's of divinity.
Mm-hmm.
I personally never had that I didn't feel called to do that. It's fine for folks that do, but I never really saw myself doing that. I just wanted the experience of learning and, going deep with my faith and so forth. And that was the most direct way to do that for myself.
Sure.
It was sort of my 7 years in the desert of West Texas where I got my degree. But what I realized was I really had no clue how to do this thing called money, and neither did most churches. As it happens, churches either never talk about money, or that's all they ever talk about, Jamie. So as it happened, I never really got much of an education on money. It seems like Jesus talked quite a bit about money, but I never really got trained on what it meant, what was my philosophy toward it. And so it was just sort of happening to me. Either you're going to happen to money or it's going to happen to you. And whether you get a sports management degree or an MDiv or, any countless of many other degrees, so many of us sort of just are handed this bag of rocks called a financial life. Here's your 401k. Hey, here's your credit card. Hey, here's your student loans. And you're just supposed to know what to do with all that stuff. And you just start putting this bag of rocks on your back, and you're sort of lugging it around, wondering, am I doing the right thing here? And many times people go their whole life and never really stop to say, well, what do I want in that bag behind me here? It's just dragging me down. And so they live their entire life. Case in point, many people I sit down with and talk to, they'll say to me, well, Mark, I want to put my money where it's going to grow consistently. I want some ready access to my money. Mark, I think taxes are likely going to go up in the future, so I don't want all my money in a tax-deferred vehicle. But they don't maybe understand that a 401k runs counter to everything I just said there. There's no consistent growth. You don't have access to the money, and it's all taxed in the future when you believe taxes will be very likely higher. So, when we act against our beliefs, even subconsciously, it creates stress and it creates, emotional conflict, right?
Sure.
And so for many of our conversations we have with folks, it starts with, well, what do you want your money to do for you? At the end of the day, we have agency over our money. It's not like money is our master. If we can be master of our money, if you were boss of money, of your financial life, if you were the boss, what would it look like? What would success look like for you? And that's sort of where my wife and I had to start. We had to say to ourselves, let's take the labels off: savings account, 401k, brokerage account, real estate. Let's take all those labels off and just say, well, what are the functions? What are the attributes that we want our money to have? And are we doing what we say we want our money doing for us? Is it actually doing that? Or are we tirelessly running after the almighty dollar?
Yeah, absolutely. So then how did you approach that question there? I mean, that's a lot to unpack, as so I guess 2008 and going forward, how did you approach things as far as taking control of your money and being the boss of your financial future?
Well, it's certainly a process for sure, but we had a couple of great conversations with great mentors too, and a long outings to the ice cream shop where those witnesses would be, just in case. But we started just creating ourselves a little list for ourselves. What is, if we were Pope of money, what would we want? What would the list of characteristics look like? And so we just started making our checklist. And in fact, your audience and anybody, I would just suggest take 10 minutes, grab a legal pad and someone you can talk to about it, and just write down, what are if we could just design a perfect financial vehicle, just poof, out of nowhere, right. What would it look like? How would it act? What would it do under circumstances, right? If your savings account acts different than a 401k, acts different than a brokerage account, or a REIT, or a mortgage note, what are the functions of the money where you put it? Because where you put your money makes it act differently. Mm-hmm. So we just started our little list, and we said we wanted a good competitive rate of return. Mm-hmm. We wanted ready access to that money without a bunch of penalties or red tape. Mm-hmm. We wanted it to be accessible tax-free. We wanted it to be always growing with guarantees. We wanted it to be able to absolutely have a bottom line that we would know for sure. Here's what we'd have at certain ages, 5 years, 10 years, 20 years. We wanted to solve for our kids' college even before they were born. We wanted it to solve for our retirement even before we started funding it. So we just knew that this was probably not legal, whatever we were thinking about. We just wanted to blue sky it for a minute.
Right. Almost too good to be true.
Yeah. Kind of we wanted it to be outside of the reach of people who could ever, if we ever went through a bankruptcy or if we ever got sued, God forbid. So we wanted it to be protected from that sort of stuff as well. I mean, paint it with me here, Jamie. What else would you want to do? I mean, what would you add to that list?
I think something that's also outside of, the FAFSA stuff when you apply for student aid and that kind of thing. And, I probably a slow growth type, guaranteed growth type vehicle that you could, like you said, access to capital. And to me, and again, I am somewhat in this world myself. To me, what I love about infinite banking and using the whole life, specifically designed whole life policy for infinite banking, what I love about it is options. It gives you options and it gives you control. And because the truth is, you don't know what your life's going to look like in 10 years. I mean, yes, you're planning for your kids' college education, and I don't know how old your kids are, but maybe your kids won't go to school. So we socked away a good bit into our 529s because that's what we were supposed to do. And I'm honestly kind of regretting that a little bit. We'll probably end up using most of it, but my son may not go to college. I don't know. We'll see. And we've got 2 kids. So a vehicle that allows for flexibility and control. Mm-hmm. Control. Those are important factors for me, for sure.
Yeah. And I had never heard of Bank on Yourself, infinite banking. So I was just sort of making my list at the time. So I'm just, hot off the degrees, kind of angry at all that student loan debt, feeling miserable about having to pay it all back. And we were doing Dave Ramsey's snowball method at the time. Mm-hmm. And a professor of ours came and sat down with us and said, Mark, you need to write this little list out. So we did that. I think he was feeling bad because, he had kind of contributed to the problem of all of our debts, but he was a great friend. He was really just a great guy. But as we started making our list, we also added things like we wanted to leverage be able to access the money as leverage for other investments we wanted to make. So he really helped give us some I thought creative thoughts without us getting into the bias of, the word savings account or whole life insurance or real estate. Take the labeling off and just talk about the function. And then he brought up, hey, Mark, is it possible Dave Ramsey could be wrong about something? He said those words to me. Is it possible that Dave Ramsey could be wrong? And that hit me like a ton of bricks because I'd followed that guy like he had written the 5th gospel or something. And so as I got into my CFP training and started diving in, I could not turn away from this compelling idea of whole life insurance being meeting all of what we had just told him. So he shared Bank on Yourself with us. We got it confirmed as I went through my CFP training, and I've never looked back. It does all of what we just talked about.
Now you say, well, you got it confirmed, but that's a
I just
formal
took
thing, or-
I went through the 3.5 years of CFP training. It took me
Got it.
took me a
Yeah,
good chunk of time to go through that training process, but it verified what he told us that day. And
Mhm.
then we found out ourselves over time,
Yeah.
beating my head against the wall, trying to prove it wrong, to be honest with you. But at the end of the day, for those who didn't already hear the other episodes,
Yeah.
it's essentially, or didn't hear the other
Yeah,
episodes.
let's do that. Let's go. What is, just kind of what is infinite banking? How does it work?
Sure. Yeah.
Or
Well,
bank on yourself, whatever you want to call it.
sure. Yeah. Yeah. Well, the reason why we distinguish there, just so you know, Jamie,
Uh-huh.
there's 10,000. Well, okay. There's 400,000 life insurance agents out there. And there's about 10,000 people that I've been able to find, meaning search results on YouTube and Google, that say the words infinite banking or
Mhm.
private wealth banking or 7702 accounts. They're all, it's sort of like when you say Xerox or, Kleenex or something.
Kleenex, right?
Yeah, right.
Sure.
It can, Nelson Nash, who started this whole thing 40 years ago, he wrote the book on the topic. He was the evangelist. I'll say it that way. He was the evangelist of the topic. He was not the pastor of the concept. He was the evangelist. And what I mean by that is he very, very late in life, he finally trademarked some things, but the horse was already out of the barn, unfortunately. And a lot of people have unfortunately used his awesome mind and heart to promote things like, well, I've seen people who thought they had infinite banking. It turned out they had some jerry-rigged Frankenstein of financial products that were still putting the risk on their shoulders, and the costs were mounting, and it was going to be taxable in the future. It was a huge mess, right? So a joint venture with Pamela Yellen and Nelson Nash kind of stopped that about 25 years ago. They'd actually Bank on Yourself was trademarked as a way to sort of quality control this whole thing, because I think Pamela and Nelson saw it happening. And so they went through and created a training program called the Bank on Yourself Professionals Program that it's almost like the difference between all natural granola bars and USDA organic.
Okay.
You can still have some really good all natural granola bars, but if you want to make sure it's USDA organic, you might want to look at Bank on Yourself Professionals. So that's the distinction.
Got it.
There's all good people and there's bad people on all sides of this, but you just, if you want that CQC, that's kind of what you'd look for.
Okay. Now that's entirely separate from your CFP training and designation, correct?
That's right. Correct. Okay. Yep. That's right. We got both for that purpose. Yeah. So okay. So behind all the scenes there, let's get back in front of the concept. What it is it's using a modernized form of whole life insurance, dividend paying whole life insurance. It's usually going to be front loaded with a massive amount of cash, and the minimizing of the commissions allows you to fully fund that policy. So you've got money in the first month, the first year, the first couple of years, and it's compounding for you on a guaranteed basis for the rest of your life. This means that you can, count on a certain amount of money in the first year, 5th year, 10th, 20th, whatever, and for every year in between. And on a minimum basis exactly what your net worth is going to be on a larger basis every single year. I mean, that's awesome. We could stop the show right there.
Right. Mic drop. No, it's especially now with all the uncertainty that's going on in all the different markets, stock market, inflation. I mean, no one knows, we don't know what to count on. Right.
Right.
And it's a very stable in and of itself, the whole life policy, which these are created with, obviously correct me if I'm wrong, but lower death benefit and a higher cash value. And like you said, lower commissions up front, which is probably one reason why there are so many bad policies out there, because the agents are incentivized not to set them up correctly. But it's a pretty slow, boring, stable vehicle in and of itself. But where the magic happens is after you set that up, right? So how does that? So let's just say, just as a quick example, how does it work? Say you're working with a client that has, $25,000 a year they can put into a whole life policy. How would that work?
Yeah. Well, boring is the right word. And I think a lot of folks come to us looking for a little bit of boring after the headlines they've been reading lately.
Absolutely.
But you're right. That's a good word for it. I never consider this an investment per se. It's a
Right.
insurance contract that you put money into, and it has a savings component to it that builds significantly. And there's some magic that begins to build over the years, but it's a long-term deal. So I always
Right.
quickly tell folks, don't just jump into this for getting rich overnight or whatever. It's more of a get rich for sure.
Yep.
So in that regard, yeah, you throw 25 grand into a policy, you're going to have less than 25 grand in the first year. Somewhere
Mhm.
between 65 and 80% of your money would be
Okay.
available in year one.
And you say available
With it.
to borrow
Oh
against,
yeah,
right?
yeah. So you can access that money. The cash
Mhm.
value can either be withdrawn or you can borrow against it.
Okay.
And so the first piece that I mentioned was it grows guaranteed. The next piece is it's accessible money with no taxes due. So that 15, 20 grand, whatever you've got in there in the first year, usually you can access it within 30 days. And that can be used for any purpose, buying your next car or investing in a basket of notes or whatever you might decide to use it for, sending your kid to college. And as you mentioned, life insurance does not get counted on the college forms for financial aid like FAFSA. So you look as poor as you can on paper.
Right.
I always say, like, if I had the big fat juicy 529 for my daughter and you had a bunch of whole life policies and nothing else, who do you think the college department is going to, offer the scholarships to? It's going to be you, right?
Yeah, absolutely.
So that's a key piece to it. But yeah, when you borrow against these policies, and what's so intriguing to me about this and why I did this for myself and for a lot of our clients is if it's designed specifically the bank on yourself way, you can borrow against the policy. And Jamie, when the loan is out, the policy continues to grow and compound as if there was no loan.
That's the part that blew my mind eventually. So I've heard of this concept quite a while ago. Of course, I did what everyone else does, and I Google it and realize it's unnecessarily controversial in my opinion, but didn't have the time to really research it or didn't devote the time. I had the time, but it wasn't a priority. And so I kind of dismissed it, as some gimmick or something. Maybe I came across a Dave Ramsey video or something, not sure, but I dismissed it, unfortunately. And then when I finally took the time to circle back and read Nelson Nash's book and actually take the time to really let it kind of sink in, it took me a couple months really to understand it. It was not a day or two. But the part you just mentioned where it's uninterrupted growth, that's what really, that was the aha moment for me, because I've never done a 401k loan, but correct me if I'm wrong, I don't think you have uninterrupted growth there. As far as I know, these policies are the only vehicle that really operates that way.
Well, let me actually, maybe I'll surprise you, maybe not. You might know this. I'm sure you know this, but saying it this way surprised me when I first heard it. Every mortgage works exactly like these policies do. You think about it, like, let's say your house is 300 grand or whatever, and you have a mortgage for 200 grand.
Right.
You've borrowed against that house and the house is still growing as if there was no mortgage, right?
Sure. Yes.
Zillow, whoever, they don't care that there's a mortgage. Or a HELOC would be another great example.
Right.
You have liquid access to the equity in your home and the home still grows like there was no HELOC on it. Now, here's the difference. With a whole life policy loan, you don't have to repay the loan on any sort of schedule. We recommend that you do. If you never pay off the loan, it'll just get deducted from your death benefit when you pass away.
Yep.
With a HELOC, there is at least an interest payment due. And oftentimes there's a balloon payment and some other things going on there with the HELOC. Also, banks can take away HELOCs. What they giveth, they can taketh away, right? Yeah. So with policy loans, it's baked right into the contract. They may not take it away from you. You have first rights to your cash value via the policy loan. Right. And so to me, that sounds like freedom. It's that old quote about Mark Twain says, a banker is a fellow who will lend you his umbrella when the sun shines, but wants it back as soon as it starts to rain.
Yeah, I've heard that one.
So that's that's some of the key differences between, let's say, HELOCs and mortgages. But I'll just mention quickly on 401ks. A lot of folks do come to me and say, well, Mark, my 401k, I can do this in my 401k.
Right.
And I say to them, well, let's kind of think it all the way through. And this blew me away again until I kind of really dug into this. I kind of saw 401ks as similar to bank on yourself designed policy loans. Right. Because when you borrow against your 401k, they'll give you whatever 1% or something on that money. while you've borrowed against it,
Okay.
in a cash account or something.
Yeah.
But let's think about it for a minute. Okay. So let's say you're making some income at your W-2 job and you got a 401k and you get a loan against that 401k to go invest in real estate or something, or just to go to Disney World or whatever you want to do with the money.
Right.
And now you're going to repay that loan according to the 401k company's own schedule, right? They're in control of that. They're the boss of your money in this case.
Right.
But at least you got your money working for you at the same time and, earning a little interest. That's kind of cool. Are your loan repayments to the 401k going to be pre-tax dollars or after tax? Well, usually the paycheck pays back the policy, the 401k loan. Think about it. Like there's an extra $700 leaving your paycheck. After tax money goes to repay that 401k loan. Okay. So that's the first time you're taxed on that money.
Right.
Now, fast forward, 10 years, whenever you're in retirement,
Right.
now you're taking that money out of your 401k to spend at the grocery store and you're taxed again.
Taxed again. Yeah, absolutely. Gotcha.
Now, if you're in a 30%, let's just say 25% tax bracket on both situations there, that's 50% tax on that single dollar. 50% tax on that single dollar. It's the highest interest rate loan I'm aware of. So it's not my favorite way to get access to capital.
Yeah, absolutely. So now, okay. Now let's just our example, say I have $25,000 a year. You set up a policy with me. We don't have to get super specific with the numbers, but just so our listeners have a general idea of what this looks like over, say, the first 5 years, what would that look like?
That's the worst part of the policy right there. So I'd love to talk about that because honestly, if folks can get past the first couple of years, the rest of it is gravy.
Well, here's the thing. Chris and I like to keep it real on this show. And that's people really, I think, enjoy that because look, notes aren't perfect. There's no perfect asset class as far as investing. Everything has pros and cons. So to me, this is one of the downsides to doing this is it's a little bit expensive up front, not so much to the commissions, but it's a slow growth thing. So so the first 5 years, how does that look?
Well, and if folks, I believe in being fully transparent about it too. One, I have to be as a fiduciary, but two, I think it's the right thing to do. So if folks go to our podcast, just search Not Your Average Financial Podcast, and then how much does it truly cost? Just search that into Google or wherever. You'll find the episode 36 and you'll see a spreadsheet of all this. So anyway, to your point, in the first few years, that's where you're overcoming the cost of the policy. So in your example, I hate doing numbers because folks are probably driving or whatever, but I'll try to keep it simple. Folks throw in 25 grand. They might have, let's say 18 grand of cash value available in the first year within 30 days. So that's like $7,000 of expense, right? If I did my mental math right. So where did that 7 grand go? Well, it went to go buy a $600,000 death benefit, let's say. So that costs something, right? They don't think you're going to die, but if you did, boy, that's a big liability that they got to come up with at the insurance company. So they don't think it's going to be you, but they know 1 out of 10,000 of us or whatever is going to probably keel over this year. So they got to hold some of that money back to cover that eventuality. All right. So in the next year, you throw in your next 25 grand. Remember, you had access to 18 and maybe you were doing some deals with that or whatever. But now you're throwing in your 25 grand and now the cash value grows by 21 grand. So that year it only cost you 4 grand, right? 25 minus 21. So it's getting more efficient is what I'm trying to get at here. And somewhere around the 3rd to the 4th or possibly 5th year, depending on your health, the policy grows faster than you can contribute to it. So at that point, the insurance company is in effect paying you. Now, they're not writing you a check or anything, but you're putting in 25 grand and the cash value is increasing by, let's say 28 grand. At that point, who paid who for that policy?
That's when things get exciting, right?
Right. Yeah. Plus you've got 6 figures of money that you've got sloshing around in your policy. What could you, Jamie, is there anything you know of that maybe you deal in that possibly people could be using 6 figures to maybe, I don't know, invest in?
Maybe mortgage notes. But I think that's one thing that's really great about this concept too, specifically for note investors, is ultimately when you buy a mortgage note, you become the bank. I mean, you're not technically a bank, right? But you become the lender and you act like a bank. And whether that's, we have listeners who are into institutional bank notes, institutional notes rather, and then others who are more into seller financing, but you become the lender. And so I think, bank on yourself fits perfectly with note investing actually. And I have a blog post myself as to how you can set this up and fund your note business through yourself, through your infinite banking system. And it really works, synergistically. And so on one hand, you're becoming your own banker. And then on the other hand, you're becoming someone else's banker.
Yeah. Yeah.
As a mortgage note investor. So I just love the concept and how those two things can work together.
Well, and so many great folks like Russ and Joey have figured out that this works. And I think the real key here is what Nelson Nash, who again, kind of the grandpappy of this whole thing, he says, banking can come back down to the you and me level. And there's a great book out there by David Graeber. It's called Debt the First 5,000 Years.
Okay.
Debt the first 5,000 years. This means banking. I mean, the history he takes you through in that book is pretty cool. Straight back from like caveman days to now. So in my opinion, in his maybe opinion, banking is about as fundamental to human civilization as like friendship is. Right. Banking will always exist. The question is who holds the purse strings.
Right.
And if some banker down the street owns the banking function in your life, you're
right
out of luck. But
sure,
Jamie, if you've got the banking function covered for yourself, for your family, your kids' college, and also you've got the business banking thing figured out. If you've got the banking function brought back down to the you and me level again, banks are out of luck, right? Yeah. And what just really gives me goosebumps is how many marriages could be saved as a result of this. How many years of one's life are you not working as a slave to pay off those student loans or those credit cards? Can you reclaim, a tenth of your life or a third of your life because you're not working, for as a slave for a bank? I mean, that's what we're doing when we're paying off our credit cards, right? Or my student loans.
Yeah. I mean, then you get it, I guess, leads me to think like, do you think this is for everyone? Is there a segment of the population maybe banking on yourself is not for? I mean, I think, our audience tends to be people who like to take control of their financial future, but I guess, on some level, I do think maybe some people are better off socking away money into a 401k or I do think Dave Ramsey, honestly, not that he cares what I think about him, but I think he's done a lot of good for people who are heavily in debt and maybe, need to get out of debt. So I guess, you can take that wherever you want, but how would you say, what would you say to the maybe the critics out there, or do you think there are people out there who this is not for?
Well, the first large group of people I would say look elsewhere are the people who are just absolutely necessarily needing a double-digit rate of return in the first year. These policies will bore you to tears. They're not investments like we mentioned. They're middle single-digit returns. If we do it right, it's middle single digit. They're going to improve under these inflationary world that we live in today, with dividends being tied indirectly to interest rates.
Right.
But I still wouldn't consider this like your, high octane investment pool, right? So look elsewhere if you're needing double-digit returns in the first year. That's probably the first group. Yeah. Even if you're not healthy, or if you've got a couple extra, like if you feel old, quote unquote, got too many candles on the cake, you can still own policies and insure others. Like I had a guy who had just had open heart surgery and he wanted a policy, but he was uninsurable. So
it's actually a really good, sorry to cut you off, but I just spoke with someone we were at 2 note conferences in Florida and we just got back, and similar thing where this guy I was speaking with had a major incident on a treadmill and he essentially died. And he's got some health issues. And I know other people who make very good money who have health issues. And I think sometimes I hear that they stop right there. They say, well, I can't do this banking on yourself thing. I'm not insurable. So you're saying there is still an option for them?
Yeah, absolutely. So this gentleman with the heart attack, I'm glad, I don't know what happened at the end of that story with that treadmill. I hope he recovered.
So
But
he recovered. I had a great time hanging out with him at the
oh
conference.
wow,
So
he said he essentially died. I'm like, was this like a
well,
ghost?
he said he died.
Wow,
But and
like
so
temporarily. Wow,
yeah,
incredible.
exactly. So I just didn't want to. Yeah,
Yeah,
I wasn't there, but
sure.
it's
Wow.
really scary, obviously. But so he's had some health, obviously a big health
It,
scare, right? And was looking into this concept, and I think has, at least for now, determined that he can't do infinite banking because he can't
yeah,
insure himself, can't
that's
get
a
health insurance
that
or
is a
life insurance
major
rather.
yeah that is a major misconception I've found. I had this gentleman with the heart attack. He just
Mhm.
got a policy on his wife and his
Mhm.
adult children and all of his grandchildren. He's the owner of
Mhm.
12 high cash value policies. Now he's one of these guys, he's a pound of the table kind of guy. Okay. And he gets his whole family around the table at Thanksgiving or whatever, and he's
Uh-huh.
like, I better never hear you go to the car dealer down the street and get a loan. You come to the bank of mom and dad.
Right.
So he's got it figured out that
Yep.
he's bringing the family banking system, if you will,
Yeah.
back to the table, and he's got his whole family participating. And they know that they are the eventual beneficiaries. They're going to be the contingent owners once him and his wife pass on. They get
Right.
these massive gifts. Let's say that they live another 10, 20, 30 years, let's say. At that point, the policies will be doing 3 times their contributions at least. So what kid's going to put money into a 401k that could go up or down? If they've got 10 grand in their pocket and they put it into the policy 30 years into the policy's life, it might be doing as much as 30 grand a year of additional, cash value.
Mhm.
Why would I put money into a 401k
Mhm.
if I could put it into that?
Mhm.
It's
Yeah.
just each person's going to have their own risk tolerance and goals, but
Right.
I would say definitely it's worth a look.
So
I
you
was
can
very
insure.
skeptical, but
Sorry
it
to.
came out to be true. Go ahead.
So you can, let's say I have health issues, and it just doesn't make sense for me to get the policy on myself. I can get the policy on family members or anyone that I have a financial interest with, right? Or that I'm
Yeah.
financially reliant on. Is that how it is?
Financial interest or reliance. Yep.
Yeah.
So that would include business partners as well.
Yeah.
I just spoke with a client yesterday. He's being courted by a pretty nice small business here in the Chicagoland area. And instead of getting the 401k, they're small enough business that they're like, well, what do you want? What do you want for your
Right.
retirement bonus? And he said, well, let's do a 162A plan. And they're like, what's
Okay.
that?
I don't know. I don't
And
know what that is.
well, it's same part of the tax code as the 401k. It's just in the
Okay.
162A section, and it's
Yeah.
executive bonus life insurance.
Okay.
So the company, his small business, will
Mhm.
pay his premium for him and even double bonus him any taxes due on that premium. Okay.
Mhm.
So he gets to keep and own the policy. They put a little vesting schedule on there for his, because they want to keep him around a few years.
Mhm.
They don't have to do that, but he has access to the money. He can use it for his real estate. He can use it for his kids' college. He
Mhm.
can do anything he wants with it. It's his money. It's just a special way, a non-qualified way to um, incentivize the best employees to stick around in
Mhm.
your business. These days, with the way employment is, that may be
Mhm.
something, if you're a business owner listening, that might be a strategy you look into, because on top of your simple IRA or your SEP IRA,
Mhm.
look into the 162A and give it to your best sales gal or best sales guy or whatever.
That's
Keep them
really
around.
interesting. Yeah, and it's just the thought crossed my mind that these life insurance companies, most of them, they're mutual companies that you are a part owner of, technically, right? And they've been around since before the IRS was even a thing, right? I mean, it's like we
Right.
just only think of the last 10 years, and we think, like you said, 401k is the way to go. Well, these these policies and these companies have been around since before the IRS, since way before the 401k was a thing. And I've
Yep.
heard a podcast with the guy who essentially created the 401k, and may have heard a couple podcasts with him, and he said that he never intended it to be the solution, for retirement. It was a good idea that just blew up into this huge thing that's on, the default that it
Yep.
is somehow our quote unquote savings plan for retirement, even though it's not really a savings plan. But
Yeah.
it's
Yeah. Well,
just
you're
like,
right. Mhm.
you know, question, we should question things, question everything that we're taught. I love all this stuff. So tell me, what else do you focus on besides the infinite banking and whole life? What else what other types of products or services do you offer?
Well, our website, lakegrowth.com, goes over everything, our comprehensive plan. And I always want to ensure folks know that we never want to be a general practitioner. I do believe in being a specialist. So we have a handful of strategies that we absolutely think we're, top notch at. And then we can give you input on your investments, your taxes, your estate plan, your business succession strategies, college planning, et cetera. We have a full financial firm for that reason, and calculators and, guidelines and strategies, and maybe most importantly, connections to other estate planning attorneys, property and casualty guy or gal, that sort of thing. But one of the strategies that we've been really fond of lately is something known as the income maximization strategy.
Okay.
And this is where, and again, I know our time is getting short, so I won't go into this forever, but I want you to just sort of imagine, what is all this for? Mortgage note investing, what's it for? Whole life insurance, packing money into a 401k, what's it all for? Well, at least part of the answer for a lot of clients that I talk to is, Mark, I want to make sure that I never, even if I run out of money, I never want to run out of my income. And the income for a lot of people is the reason why they're putting money into a 401k. And it's the reason why they're getting, all this.
Makes no sense.
Yeah. I know. Yeah. You've been hearing the stuff with Ted Benna, the father of the 401k. He's, it was pensions that the 401k replaced.
You're right. Right.
Pensions have been around since the Roman Empire. In fact, I went to a museum. I was just there with a buddy because, again, I'm kind of a Bible nerd. And so there's this museum in downtown Chicago. It's called the Ancient Oriental Institute. And it's the largest collection of like Mesopotamian archaeology in the Western Hemisphere. It's like, nerds like me, it's pretty cool. So anyway, alongside all these like old clay tablets and other cool mummies and stuff, there was this annuity contract on the wall from 365 BC.
Wow.
Wow. So
that's wild.
Again, Dave Ramsey would be pounding, he'd be upset at us for talking about this, but annuities work. I mean, they really do. Private pensions, that's what annuities are in essence. If you like the idea of guaranteed, predictable income that you cannot outlive, you want to look at modernized annuities, the kind that they don't keep your money if you pass away. The old kind did. This kind, if you pass away, your family gets the rest. And you can still access a good chunk of it, even if you needed it for emergencies, whatever. So these new, more modern annuities can provide what we call the income maximization of your retirement. Case in point, and then I'll hush and get your thoughts on this. Let's say you got $1 million in a 401k. What's the best research? I'll just let you throw a dart at this, and everyone's wrong on this, so please forgive me in advance. But
we can edit it out when I say something.
Yeah, good. You can just auto tune that to the right answer.
I'm never wrong. So,
so you got $1 million in your 401k. What do you think is the best research that tells us exactly, that'll give you, let's say, a 90% success rate to get that money to live on for the rest of your life these days?
The best research.
Yeah. What's the withdrawal amount? How many dollars should you take out? How many dollars should you take out of $1 million?
So I know the 4% rule, right?
Yep. 4% rule. Mm-hmm. Yep. Mm-hmm.
Which I think is probably not enough now.
Yeah. You actually brought up something most people don't know about. So Jamie, you're right, man. You didn't even have to edit that.
Ding, ding, ding.
4% is in the 1990s, they came up with 4%. So on $1 million, you'd be able to live on a lavish lifestyle of $40,000. Now, 25 whatever years later, it's 2.8%. So that's 28 grand, $28,000 is how much they're telling us. Wade Pfau and Michael Blanchett and several other retirement researchers at the American College and at Morningstar, Dr. Wade Pfau among them, says you should not take more than 2.8% of your money out each year. This means the millionaire lifestyle is living on $28,000 a year.
Wow. Yeah.
And that's a
crazy.
401k. So that means that means you got to pay taxes on that, right?
Right.
So 28 grand minus taxes might be, I don't know, you tell me, 22, 23 grand a year,
Sure.
a year. So
now that's come down partially because people are living longer, I guess.
living longer, bond rates have fallen, volatility, beta on the market has gone up. So all of these factor into, and that only gives us a 9 out of 10 success. So would you get in an airplane if there was a 9 out of 10 success? So annuities give you 3 times as much as that most of the time, depends on the annuity, of course, but you can get 3 times as much income with a lot less risk because you're using something called mortality credits, which we don't have time to get into today, but it's another insurance contract. Again, I believe in this idea of contractual wealth. Bank on yourself uses contractual wealth, contract with you and the insurance company. The income maximization strategy uses contractual wealth, not paper wealth like Wall Street gives you, but contractual wealth, which gives you an absolute guarantee.
Why don't I take that money that's in the 401k or wherever else I have it and put it back into the whole life policies? Why would I go the annuity route?
401k money typically cannot go into life insurance unless you're funding it after tax. So you'd have to take the money out of the 401k, pay your taxes.
So you're saying I can invest in the annuities in my 401k. I gotcha. Okay.
Yep.
And then, but that doesn't really help with cash flow unless I'm retired. Is that right?
Well, whenever you're ready to retire, you flip that switch and it's a permanent stream of guaranteed income that you want to live.
That's pretty cool. Hadn't heard that concept yet. So
it's mind-boggling. My wife and I have several of those annuities. We have, of course, several bank on yourself design policies as well. They work well together. It's like a river of money, the annuity is, and then the ocean of money, which is your policy.
Okay. Well, that's one thing I love about the kind of infinite banking or bank on yourself practitioners that I've come in touch with, like Russ and Joey, and also Anthony Faso. I was on their podcast with Cameron. But the people that I've dealt with, they actually practice what they preach. I think when Russ has some, I don't know, 20, 25 policies, if not more, and so you obviously believe in it if you're doing it.
You ask any investment advisor, you say to your investment advisor, hey, what do you have in your portfolio?
Right.
And just sit quietly for a minute and see if he or she even answers the question. And if they do, figure it out and then maybe go do that. Because you're right. We really need to, eat what we're cooking, so to speak. In the financial space, especially.
So now I know Russ is a former financial advisor. And I think Anthony Faso is maybe a CPA or former recovering CPA, I think he says. So I'm just curious, you have kept your CFP designation. So it seems like maybe that's one way that your business is structured slightly differently. Is that fair to say? That's
right. Yeah. On a podcast, I can talk all about things I love, but I never give out recommendations over the podcast.
Sure.
Partly what we do is we follow the CFP process. Certified Financial Planner designations force you, and I think it's the right thing to do. Just help people through a step-by-step to make sure whatever we give them in terms of recommendations is in their best interest.
Yeah, that makes a lot of sense. Now, as we wrap up here, this is the Good Deeds Note Investing podcast. Can you think of an example of a way that you've done a good deed through your business, or a way that one of your clients or someone else has benefited through your business?
Well, we keep a lot of our good deeds kind of private, under the radar for our personal charity and everything. But in the business, it's a daily thing, The conversation I had with someone just the other day, we helped him. He had built enough money in his policy. He'd been paying down his mortgage to a certain point, and he'd been building up his cash value in the policy. And so he took a loan from the policy and wiped out the mortgage. And I just like cheered with him on the phone. I said, nice. Take a picture of that mortgage when you're throwing it in the fireplace, and I want to see that thing burn. He nice. Was the kind of, I don't recommend everyone pay off the mortgage, but he was this kind of guy that really wanted to do that. And so he was proud to do it, happy to do it. It's a life changer for him. He can do things now with his cash flow that he couldn't do before. So it's fun to sort of see that thing happen again, almost on a daily basis.
No, that's great. And that's what I love about, I say this almost every episode, but real estate notes, small business, there's so many ways to approach it, and it's everyone's situation is different. And it sounds like you, in your business, you take the time to listen to your clients and actually, tailor the solution, or the strategy, if you will, to their situation, because everyone has different a different background and different circumstances, but also a different future, different goals. So you really
Yep.
can't just slap a one size fits all, solution onto everybody. But that's really good. So, and then lastly, so how about a note and bolt, just a piece of wisdom or a piece of information for our listeners that they may not get in a training seminar or a book?
I have been just gobbling up the Jim Rohn library lately, so forgive
Okay.
me if this
Yeah.
is one you've heard before, but he says here's the quote: everyone either has to get good at planting seed in the springtime or begging in the fall.
I had not heard that one. That's
a
really
great
good.
one, huh?
Yeah, that's
Either
really good.
everyone has to get good at planting the seeds in the springtime or begging in the fall. Great stuff by Jim Rohn.
Love it. That's awesome. This has been really good. So is there anything else you think we should have covered that we haven't touched on?
Well, folks, if you love podcasts, you mind if I share where
No,
they can hear
absolutely.
it?
Go for it.
Check out Not Your Average Financial Podcast. Not Your Average Financial Podcast. We just launched as of this recording. We did an episode on what we're calling the periodic table of abundance, where we
Nice.
kind of go over the big picture. Like, what's the periodic table in your financial life? Are there elements missing? If you don't have oxygen in your financial life, things are not going to go well for you, so to speak. So liquidity, business, real estate, estate planning. We put it all together on one episode. It came out as of March 18th, 2022. It's episode 237. Just go to notyouraveragefinancialpodcast.com if you want to learn more about how to become your own source of financing without taking a bunch of unnecessary risk. There's a big button there that says request a meeting. If you want to say hi to me for 15 minutes, we can answer any questions you have. That's notyouraveragefinancialpodcast.com.
And then your website is lakegrowth.com, right?
That's right. Great. Lakegrowth.com if you want to just learn more about our firm.
A couple of things come to mind real quickly. One is I refused to memorize the periodic table when I was in high school, because I said, isn't that the point of having the table? So
that's right.
Look at it and refer to it, use it as a tool. But that was me being, a little stubborn, I guess. And then secondly is more on a serious note. I mean, I can relate to this. I've done a lot of thinking about my own financial situation, my family's situation, but I think everyone could use a little, maybe take a step back and look at everything as a whole. So, we've done some estate planning, we do notes, we have certain things, but that maybe are a little bit disjointed. So I really like that approach. I'm gonna have to listen to that episode myself. So that's really good.
I agree. I think it's funny that we still tell our kids to memorize like all the capitals of all the 50 states when they could just grab the internet anywhere in their pocket, or the periodic table. Thank goodness this one's got 12 elements. That's all it is so far.
Okay, good. I can probably handle that. One per month, maybe.
Good stuff. In fact, that's what we do. We have a membership site that we've put together, and once a month we go over each of the elements and help folks with daily bite-sized action items on it. And you can get to that through the podcast website as well.
Awesome. It's really good. So yeah, we'll have to have you back on if you have time, Mark. I mean, there's so many rabbit holes we could have gone down that we kind of glossed right over. And I know there's, just a ton of information that you have and that you, that could benefit our listeners. So I definitely recommend our listeners reach out to you if they think it could benefit them. And I really appreciate you coming on and, hearing your story. And like you said in the very beginning, I think it's we just don't learn this stuff, in school. And it's so important. Money is not the end goal, but it's not something we should ignore for sure. So
money's been around for thousands of years. Whole life insurance has been around for several hundred years, and yet they still don't tell you about it. Why do you think that is? So that's interesting. We sure learn a lot about the stock market if we're going to be taught anything in school. I know that I had in 5th grade, they gave me some like Coca-Cola stock, clip it out of the newspaper, and that sort of thing. But that's about as much as I learned about money and investing. And yet, where was all this in our growing up days? So
Yeah,
man, I'm with
absolutely.
you on that. And Jamie, mortgage note investing. So wow, let's just say given that you are now teaching folks this, what could our kids and our grandkids possibly see happen in their lifetimes with the kind of information that you guys share on your podcast? So last call to action for everyone listening.
Yep.
Give Jamie and his team a 5-star review, because you guys do a great job. I've listened to a
Thanks,
few of
Mark.
your episodes. They're great.
Appreciate that. And thanks a lot for joining us, Mark.
Thank you.
And to the listeners out there, don't forget to go out and do some good deeds. Take care, everyone.